This is VeriScope News. We report verified data with clear context. No opinions, no noise. Today's report covers the Consumer Price Index Summary released by the U.S. Bureau of Labor Statistics at 8:30 a.m. Eastern Time on Friday, February 13, 2026. This report measures changes in prices paid by urban consumers for a broad range of goods and services. It is one of the primary inflation indicators in the United States. We will review the official figures, place them in historical context, and explain how the index affects households, businesses, and the broader economy. All figures are drawn directly from the official release. The Consumer Price Index, or CPI, tracks average price changes across categories such as food, housing, transportation, medical care, and energy. It reflects out-of-pocket expenses paid by urban consumers. The CPI is published monthly. It includes both seasonally adjusted and not seasonally adjusted data. Seasonal adjustment accounts for predictable patterns such as weather, school schedules, and holiday spending. The year-over-year measure compares prices to the same month 1 year earlier. The month-over-month measure compares prices to the prior month. These two measures serve different purposes. Month-over-month data reflects short-term changes. Year-over-year data reflects longer-term price trends. Central banks, businesses, and households monitor both. The CPI influences wage negotiations, contract adjustments, and government programs. It also serves as a benchmark for inflation expectations. In January 2026, the Consumer Price Index for all urban consumers increased 0.2% on a seasonally adjusted basis. In December 2025, the month-over-month increase was 0.3%. The difference between those two readings is negative 0.1 percentage points. This indicates a smaller monthly increase compared with December. Over the past 12 months, the All Items Index increased 2.4% before seasonal adjustment. The prior 12-month increase was 2.7%. The difference between those two readings is negative 0.3 percentage points. No revisions were stated in the January release. The data reflects prices collected during January 2026. The index covers urban consumers, representing a large share of the U.S. population. The report does not include rural households, farm families, members of the armed forces, or individuals in institutions. The CPI remains one of the most widely referenced measures of inflation. Over the past decade, inflation has moved through several phases. In the mid-2010s, annual inflation generally ranged between 1.5% and 2.5%. In 2020, inflation slowed sharply during the early phase of the pandemic. In 2021 and 2022, inflation accelerated as demand recovered and supply chains faced disruptions. During that period, year-over-year inflation exceeded 7%. In 2023 and 2024, inflation moderated as supply conditions improved and demand growth stabilized. By 2025, annual CPI readings moved closer to the 2 to 3% range. The January 2026 year-over-year reading of 2.4% remains below the 2022 peak. It is also below the 2.7% reading recorded in December 2025. A 0.2% monthly increase, if sustained, for 12 months would imply an annualized rate near 2.4%. A 0.3% monthly increase implies a higher annualized pace. The difference of 0.1 percentage points in a single month may appear small. However, cumulative changes over multiple months affect annual totals. Inflation trends are measured across many categories. Housing often carries the largest weight in the CPI basket. Energy prices can introduce volatility. Food prices can reflect both domestic and global supply conditions. Medical care services reflect insurance and provider costs. Each category contributes differently to the overall index. The CPI is calculated using a weighted average of price changes across these categories. Weights are based on consumer expenditure surveys. The Bureau of Labor Statistics updates weights periodically to reflect spending patterns. The CPI uses a fixed basket approach. This means it measures the cost of purchasing a consistent set of goods and services. It does not immediately reflect substitution behavior when consumers switch to lower-cost alternatives. This methodology provides consistency over time. Households. For households, a 2.4% year-over-year increase means that, on average, goods and services cost 2.4% more than 1 year ago. If a household spent $1,000 per month last January on a representative basket, that basket would cost about $1,024 this January. A 0.2% monthly increase means prices rose by $2 for every $1,000 of spending compared with December. These changes affect budgeting. They influence purchasing power. They shape expectations about future expenses. Households with fixed incomes may monitor inflation closely. Government programs, such as Social Security, often adjust benefits based on CPI measures. Private contracts sometimes reference CPI adjustments. Prices. Price changes can occur across multiple sectors. A broad CPI increase does not mean all prices rise equally. Some categories may rise faster. Others may rise more slowly or decline. The aggregate figure of 0.2% reflects the net result of all components. Small differences in monthly readings accumulate over time. A sequence of 0.3% monthly increases would produce higher annual inflation than a sequence of 0.2% increases. Stability supports long-term planning. Gradual price growth differs from sharp swings. Inflation measures allow policymakers to assess conditions without focusing on individual price movements. Jobs and labor. Inflation interacts with wages. If wages grow at a faster pace than prices, purchasing power increases. If wages grow more slowly than prices, purchasing power decreases. Employers consider inflation when setting compensation. Labor contracts sometimes include cost of living adjustments. Stable inflation readings provide clarity during wage negotiations. Lower year-over-year readings may reduce pressure for rapid adjustments. However, wage growth depends on labor market conditions, not solely on CPI data. Savings and investment. Inflation influences the real return on savings. If inflation is 2.4%, a savings account earning 2.4% would preserve purchasing power before taxes. If returns exceed inflation, purchasing power increases. If returns fall short, purchasing power decreases. Investors track inflation to evaluate bond yields and other fixed-income returns. Long-term contracts, including leases and government securities, may include inflation-linked provisions. A difference of 0.3 percentage points in annual inflation affects long-term compounding. Over several years, small differences can change total real returns. Businesses. Businesses monitor CPI to assess cost pressures and pricing decisions. Input costs such as materials, transportation, and labor may reflect broader inflation trends. A slower monthly increase may indicate moderating price momentum. Companies often plan budgets based on expected inflation ranges. If inflation remains near 2 to 3%, firms can project expenses with greater stability. Unexpected acceleration or deceleration may require adjustments. Retailers also track CPI as an indicator of consumer purchasing power. Analysts will review upcoming CPI releases to assess whether the 0.2% monthly pace continues. They will also monitor the core CPI, which excludes food and energy. Additional reports include the Producer Price Index and the Personal Consumption Expenditures Price Index. Labor market reports may provide context for wage trends. Energy price movements can influence future CPI readings. Housing data may affect shelter components within the index. Each monthly release contributes to the broader trend. No single month determines long-term direction. The January CPI shows a 0.2% monthly increase and a 2.4% annual increase. Both readings are lower than December's figures. The changes are measured in tenths of a percentage point. For households, this represents gradual price growth. For businesses, it signals continued but moderate inflation. For savers, it defines the rate at which purchasing power changes. For workers, it frames comparisons between wages and prices. The data does not provide forecasts. It provides a snapshot of price levels during January 2026. Understanding the difference between month-over-month and year-over-year measures helps interpret the report. Small monthly differences can shape annual totals. Consistency across months supports planning. The CPI is constructed using a multi-stage sampling process. Price data is collected from thousands of retail and service establishments. Housing data includes rental surveys and owner-equivalent rent estimates. The Bureau of Labor Statistics uses statistical techniques to ensure representative coverage. Seasonal adjustment removes predictable fluctuations. For example, gasoline prices may follow seasonal demand patterns. Food prices may vary based on harvest cycles. Seasonal factors are updated annually. Not seasonally adjusted data reflects actual observed price changes. The CPI base period equals 100 during a defined historical average. Index levels above 100 reflect cumulative price increases since that base period. Percent changes are calculated from index levels. For example, if the index rises from 300 to 300.6, that represents a 0.2% increase. Year-over-year changes compare the current index level with the level from the same month 1 year earlier. Rounding may cause minor differences in reported percentages. The CPI does not measure asset prices such as stocks or real estate values directly. It focuses on consumer goods and services. Weights determine each category's influence. Shelter typically carries the largest weight. Transportation and food follow. Smaller categories contribute less to overall changes. Data collection follows strict schedules. Release times remain consistent to ensure transparency. All data is publicly available at the scheduled release time. This methodology supports comparability across decades. It allows researchers to track inflation trends over long periods. This has been VeriScope News. Today's report covered the Consumer Price Index summary released at 8:30 a.m. Eastern Time on February 13, 2026. January's month-over-month increase measured 0.2%. The year-over-year increase measured 2.4%. Both readings were lower than December's figures. No revisions were stated in the release. We will continue to report verified data with clear context. Thank you for watching.